All right, everyone. Welcome back to the Canadian Real Estate Homefront Podcast. This is episode 16, 15, 16?
16. I just checked.
Checked. All right. All right. Yeah, we had Daniel Foch on last week. That was really
cool.
fun.
That was
yeah,
a good episode.
Yeah, we got some awesome reels that we'll share with you guys too on there.
Lots of information.
Yeah.
Be prepared for that one.
Technical, analytical, economy, controversial.
I had a friend that said, no, just give me the Coles notes. I'm too anxious to watch it because he's being affected a ton by what's going on. And he's like, I can't watch it. I don't want to listen. Just give me the Coles notes. Like, no, you got to watch it.
You got to watch it. Well, I guess that kind of segues into our first topic here. So the Bank of Canada raises rates again. Like, why are they doing this? So the Bank of Canada raised rates yet again by 25 basis points to 5%. That's kind of their overnight rate.
The highest since 2001.
Yeah.
And just to put into perspective, the difference in average price in Canada from 2001 to now, how much that is major.
Yeah.
Back then, it used to be the norm because your mortgages were so much smaller.
Yeah. Yeah. I think I saw a tweet and Toronto and Vancouver were roughly like $250K for a house back then. Yeah. And now it's over 1.1 million.
Right.
So yeah, that's a good point. Very good point. Yeah.
Because we hear the, older generations being like, my interest rate was 15% and all of that, but their mortgage was so small. So it's as if, and it'd be interesting to do the math on it. So what we pay in interest at 5.1% or 5%, plus what the bank's like, 5% is just the overnight rate. That's not even your mortgage.
You're at
7, right? Yeah. 7 is prime now.
Yeah, that's probably your +2. Yeah, your fixed rate for 5 years probably around 6.
Yeah.
Yeah.
So at that rate, on our amount of mortgage on a house versus 15% on 200K, like the difference is still substantial. Still substantial. So it'd be interesting to see what that rate would correlate to on a house that's 250,000. It'd be like, oh, you're complaining that it used to be 15%, but in today's rates and mortgage amounts, that translates to your rate having been 40% or whatever the case may be. To have that huge effect. Yeah, there's a lot of people talking right now too. Like, why are they continuing to raise? Like, there's kind of these two different camps. Like, you're hurting people. Like, I think Jagmeet Singh tweeted out something about Justin Trudeau hurting people once again, and about the rates raising. But I think what happened, honestly. Why does he say Justin Trudeau though? Because I think it's just like he's blaming Trudeau. Okay. Yeah, I know they're supposed to be. They're different. Yeah, it's political theater. He's basically just he's trying to get people to elections coming up soon. He wants votes. Right. Yeah. Okay. But I think a huge reason why is the economic data is there too. But when they paused, the real estate market rips, right? Because people said this is it. Yeah. Right. And they have to bring that down. So I think when I was listening to the press conference too, it's very evident that what they say is like, okay, look, the rates are doing their job, but not as fast as we thought. That was something that they said. And then they also said, and I'm paraphrasing it because they said it in a better way, but they're basically like fighting the Liberal government because immigration is so high, right? Which is putting pressure on inflation. And they brought in 1 million people last year to fill our job vacancies because there was a lot of job vacancies and to increase the jobs, like increase supply essentially, right? Immigration usually translates to increased productivity in our economy. But if you increase supply, but also increase demand with that many immigrants, you're still in excess demand if you started in excess demand. Right. So if you add both, you're still in we're still in a demand supply imbalance. And they're also, we do have deficit spending as well. And that definitely fuels inflation when you spend money. And so you got to look at it too, because we talk about the real estate part of the economy. So that's not the only sector that the rates affect. Corporate pricing, like the price of goods and services, right? The service industry, like things are still very expensive. Yeah. And they're trying to bring the costs of all of that, like as a blanket, not just the real estate market, although it kind of did that uptick when we held. There's still, I think, what did they say? Like meat, what else? Meat, bread, coffee, rents continued to rise like very quickly. So it's not just house prices, but not just house prices, goods and services too. So right. That's a good point. Yeah. Like even, we do talk about
the cost of housing. Obviously, we're a real estate podcast, but just think about like going to get a new car right now, right? Like I remember when I got mine, I locked in a 7-year 1.7% rate with RBC, and now you're looking at 6+% for a new car. Like who's car shopping, and then who's going to be, house shopping at this point too, right? You're going to see that pullback come within the housing market too, because you're going to have to swallow this 6% interest rate stress tested at 8. So.
Well, back to your car point, is that who's car shopping right now? Well, if a lot of people aren't car shopping or wanting a new car because of the interest rates, that's going to bring down demand, which is going to bring down prices or not make them rise as quickly, right? So what hurts more? This interest rate right now that a lot of people with new mortgages or variables, yes, are suffering, or fast forward 2 years when the cost of a car is astronomical, or the cost of getting your bread and your baby's food is astronomical, because it only goes kind of one way when interest rates are low, and especially with bringing in more people. So essentially, I think what Tiff Macklem's doing is measuring pain, which is going to hurt Canadians long-term more, because there's a long-term goal in his mind. I think
put the economy into a recession to kill inflation. I think that's pretty much, pretty much like where he's going with this, because when he paused it did not stop.
What would you do?
I would raise it. I don't know. I'd see what happened after this, but these are the options. You slowly raise it, right? Or you raise it more. Like say he just went 50 basis points and just really killed inflation. It would almost make it happen quicker. Because there has to be pain, right? You're going to see people who are forced to sell. It's just going to happen. And to be honest, people are like stuck in their homes right now because you don't have an alternative. Like, what are you going to do, right? Like, I can't upsize right now because the interest rate's too high, so I'm going to stay. My amortization's 50, 60, 70 years. I'm not going anywhere. I'm hanging on.
Yeah.
Or, even people who are like our parents' age, right? Like I was reading an article just about all these empty bedrooms and all these homes. And it's because the delta isn't there for them to downsize.
Right.
It's everyone always asks, where am I going to go? What am I going to do? Right. So I think long and short, I'd see what happened after this. Like, I'm pretty sure he's done after this, unless we see some crazy economic data, people still spending, and the real estate market starts to rip. But what do you think?
Well, like bringing in that many immigrants is obviously going to put pressure on prices and increase spending, right? You come here and that's 1 million more people being added to the pool of buying goods and services. So you're increasing demand, and unless supply keeps up, you're essentially putting so much pressure on inflation. So then, like I go back to, I do not envy his job, because everyone hates him right now. Why are you causing so much pain? And it's a measurable pain, because the alternative is you'll never get into the housing market, like, ever, or maybe right now you have to stay and you're broke right now. But look at 5 years down the road, if what his goal, if he's not making these moves to achieve the goal, which is price stability for Canadians. And I see that, and there's no right or wrong answer. Like, I don't think he's made a mistake by raising it, because the data's there. It's really in front of you, as the cost of everything is still going up at a quick and unsustainable rate. And what else is there to do? Yeah, you have to raise, right? His hand is forced. So I think we're still really recovering from what happened during the pandemic, and how the government provided solutions. Yeah. And we're still in recovery mode. Pent up demand is huge too. Right. You have a lot of people who saved a lot of money because they were sitting at home. Yeah. And now, you go to the bar and you're excited still. Like, exactly. That trip you wanted to go to Europe and you had to cancel 2 years ago, now you're going. And that fuels spending, and that fuels the data. So I think, they're going to keep raising. I think maybe they'll pause next time. We'll see what the data says, but he said blatantly, we're prepared to raise again. Yeah. I think he also understands that there's a lot of people on the scale of being hurt way more than others. But if he's looking at the economy and price stability for Canadians as a whole, there's not really too much alternative with what we have or what he has at hand. Yeah. Right? Obviously, we talk about solutions like we need more supply. If you increase supply to match demand, that's going to solve a lot of issues, but that's not as easy. No, it's not that easy to do. And I think that, a big reason why we haven't seen the market take a dive is because
people are just staying put. Like supplies like at a 20-year low. I think it's, you know, pretty much down there in the depths of COVID too. So that's obviously going to fuel demand. But if you do see some forced sellers and you do start seeing people who have variable rates who are investors start hitting the market, you know, how long can they hold on for? I guess we'll find out.
Yeah. And the interesting thing is that people are saying, hey, send me foreclosures or powers of sales. So the banks still want top dollar for the house. And in a market where things are still moving decently quick and there's still demand in the market, whether it's a foreclosure or power of sale or just a seller selling, it's still going to move and still going to have the same amount of interest. So it doesn't mean it's going to go under market value. The bank wants to be paid back. The bank 100%. Is obligated to try to get the top dollar for it.
Yeah.
So a foreclosure or me selling my house in a market where demand is strong doesn't mean the price will necessarily be different, right? So the demand, if it's there, even with forced sellers, until we see way more supply, foreclosures and powers of sales isn't a thing to look out for right now. It's still going to sell for a market value.
Yeah, and it's even interesting too. I was talking to this girl, and it's a market way out of my jurisdiction, but she was saying like her friend was kind of stuck in this situation where they closed on a house, and I didn't quite understand it fully, but I think this is the gist of it. They closed on the house, but they need to move the closing date up because their pre-approval ran out. It's like running out like the end of July, but their closing date's the end of August, but the deal's already firm. So why this is a boo-boo is because people think, and like, I'm not blaming the buyer, like the agent should know, the mortgage agent should make this very clear. I always make it clear too. And people are like, what do you mean? When you get a pre-approval, you have to close on the home. That closing means the money has transferred to the seller, right? People think that I have a pre-approval till July 31st, but I can close whenever. I just need to buy
firm though?
Yeah. Like this was already, and I think like the bank was going through it, and they're like, and you know, and since then we've had 2 rate hikes or something like that.
And so those rate hikes not only might be way different than what your pre-approval rate was, because some people sold their house and are locked into like their rate that they can port. So if they let that run out, they're going say 2% to now 7%. That's massive, number one, in terms of money out of your pocket. But number two, might actually make you not qualify for the amount. And then the difference of what you qualify for, you gotta come up with the cash.
That's why I even brought it up, was because like, you know, someone listening to this probably was like, wow, like I've had this before too, where I'm talking to clients and I'm like, when's your pre-approval done? And they're like, here. And I'm like, we need to close before then. What I mean by that, because like, you know, sometimes we use these terms like firm deal and people don't understand them. So like, I'm like, you have to actually be moved into that home by the time the pre-approval is done. And they go, oh, our broker never told us that. Like, that's the first thing what the bank should tell you, so you understand.
I go back, it's so much education.
That's why we do this podcast.
Like the real estate sector of buyers, sellers, realtors, mortgage brokers, like education needs to come number one. It's not about just getting you into a house. Like you need to be educated.
Yeah. That's why the most educated realtors honestly probably do the best, or like have the best book of business, right? Yeah. There's realtors who market like crazy, the guerrilla market, and they do well as well, but you're attracting a different kind of clientele. I think people who want to be educated and who value, you know, what our opinions are the best people to work with, right? Because they're hiring 100%. You for a reason. They see value in you. Yeah. Some people see realtors as just
want your advice. Like I have a lot to say.
Yeah.
You know, and maybe not necessarily always. It's like I have an opinion too.
Yeah. You're not shy.
There's 2 sides to everything, but I had that happen to me too, where my sellers. We got an offer and we needed a closing date because they had kicked out their tenants. You have to live there for a year before you sell. And the closing date that we got from the buyers was earlier than a year. They didn't want to have any sort of litigation with the tenant board if the tenant went back and said they sold before a year, all that. And anyways, they said, we absolutely cannot, because we lose our rate hold as of this day. The banks sometimes are able to push it if it's like plus or minus a week, 2 weeks. But they couldn't close. So in that situation, it's actually smarter to like pay the sellers off, have an Airbnb, like do whatever you can to make that closing date work. And the amendment to, I guess in her case, change the closing date. And Like if it's a difference of 2% to 7%, I'd be offering like, I'll pay for your Airbnb. That's going to cost me way less. A month's difference. If the seller knows they're moving anyways, 30 days.
Yeah.
They'd be like, I'll put you up in the Drake Hotel.
Just let me close. So. I think too, like, okay, here's the scenarios on this situation, right? Is like, what happens if you're someone who did that and you can't close on the home? The seller has to go back onto the market, and then they have to try and sell the home in a different market and a higher interest rate. And then if they can't get the number that you offered them, then they can sue you for the difference, sue you for damages, sue you for carrying costs. Like, it's a nightmare.
Yeah.
So like, what would I do in that situation? Obviously, you want to talk to your lawyer, but you'd want to close earlier, even though the sellers won't move. They're like, no, we need the house. Like,
let the sellers stay.
Just do like a month lease back at $1 or something. Cause there has to be some sort of transaction or change of hands. Again, talk to a lawyer about this, but that's what you'd have to do. Is you'd have to close earlier. Yeah. You can't just walk away. Like, people think too, like, oh, they're just going to take my deposit. No, the deposit's still held in trust. You're going to have to go to small claims court. It's a mess, but there always are solutions, basically. Not always, but in this case there was.
Most of the time there is a solution.
Some sort of solution. But if people did their job to begin with, right? If the mortgage agent explained to them, or maybe they just worked with the bank, explained to them, you have to close. This doesn't mean you buy before then. You have to close. They would have had that in the back of their mind, and they probably would have been able to avoid this. But anyways, just some education for people.
Yeah. What do you do in a situation? So this is currently something that I have on my docket. So last summer, we were selling assignments for a builder. Okay. A lot of people came to us direct. So our clients are the sellers of these assignments. And then the people that came to us direct is basically, how an agent can be representing somebody as a client and a customer service agreement, right?
Yeah.
So there's two ends. Facilitated the assignment, and now those are coming up to closing, right? And they've come down in price, of course. Okay, so he's saying, please put in an amendment to change my purchase price by $100K. And the seller's like, no way, buddy. And I'm like, oh my goodness, I have something on my hands here.
Yeah.
And he's saying he won't be able to close because the comparables in the area are selling for this. So when it comes to appraisal, a couple months or a month before closing, it's not going to appraise. And he needs to put the remainder in cash. So that's a sticky situation for people that bought assignments last year and are approaching closing this year. Prices are so much different. Number one, it won't appraise. So even if you were qualified for the new rates and the high purchase price you bought for, great. But will the bank give you that loan if the appraisal comes in short? No, the bank's only, and that's why your pre-approval has conditions, because if you're pre-approved for $1 million, you can't go buy a shack. It's almost to stay away from fraud, essentially. You can't go buy a shack for $1 million. If it's not worth $1 million, the bank's not putting
not touching it.
$1 million loan on it, because if something happened, you couldn't pay their mortgage. They wouldn't be able to sell it and get their money back. So the bank's at risk in that case. So if the property doesn't appraise, you got to come up with the remainder. So I think a few people are tight in these sticky situations where I think the firm approval that we talked about too from RBC is so golden. I heard somebody pulled their firm approval though.
Oh yeah,
a bank pulled it. I don't know if it was RBC. Maybe it was. I don't want to quote any bank. I actually don't know who. Somebody said they pulled a firm approval. So it's interesting to hear these stories one-offs when you think it's a firm approval. You're good. What's in the fine print?
Yeah. Maybe you got to go down that rabbit hole a little bit more just to make sure that you are safe. Yeah. Do you want to read our next topic here? Topic 3.
Topic 3?
Yeah, right there.
Oh, okay. Bank regulator steps in to deter banks from extending mortgages to as long as 90 years. I think that is a good thing. It's going to hurt people, but it is a good thing. It's like short-term pain. 100%. Anyways, as interest rates continue to increase, some variable rate mortgage borrowers are seeing their amortization periods extend to 60, 70, even 90 years. Canada's federal regulator is now acting to reduce the risk posed by such forever mortgages in quotations. On July 11th, the Office of the Superintendent of Financial Institutions, OFSI, you probably know it as, proposed changes that would make banks hold on to more money to address risk related to mortgages with growing balances. So they want the banks to have some sort of
collateral.
Yeah,
exactly. Yeah.
I like that That's like, it should have never been a solution to allow sellers to push their amortization schedule, extend and pretend. It allows people to stay in their houses, which now there's not as much supply. When people normally would have had to go to market and sell, they can just stay. Their payment stays relatively the same, especially if you're going to pay back your mortgage over 90 years.
Yep.
So the people that are doing that, if they bring them back down to a normal schedule, you're going to have to either put down a lump sum, increase your payment, or I guess sell.
Yeah.
I saw a lot of sellers. There's a section on House Sigma that said sold below bought.
Yeah.
Meaning.
Some of those don't close too. So a lot of those are going to be lawsuits. Like if you actually like look at the Geo Warehouse, because sometimes I look, I'm like, there's like how? Like what do you, that's like a $300,000 difference. I've seen some like really bad. But yeah, some of them don't close. So it'll show on House Sigma is like, oh, it's sold, and it did sell firm, but the person never closed on it. Yeah. So they had to go back to market.
And then
they sold
so
below.
It's the same person.
So that seller is going to go after the first buyer for that difference of money, as you know, as they should. So I think we'll see a few court cases that, you know what, it will be interesting to see those court cases over time. They're going to take years, but to see what happens with them. Because there was one in Vancouver where these people just walked away. And I think it was during the time where the foreign tax came in, and they sold for like $1 million less or something.
$1 million
less. Yeah. And I actually made like a TikTok video on it before we started this pod together. Yeah.
I remember it.
Yeah. And this seller actually won in court, and they had to pay them
$1 million. Okay, so what if you don't have $1 million?
That's a good question. I don't know.
What do you do? Do they garnish your wages?
Well, that's what it will be interesting to see, like real estate law going forward too, to see what happens here.
Changing again. We're in the recovery stage of the pandemic, so things that used to maybe be a solution for people, like extending the amortization for one-off people, like we're realizing what works and what absolutely cannot be a solution here. So I think we're in the works of new policies and
I think OFSI is going to really, and I think Foch talked about it too. They're going to really like clamp down on this and get rid of this variable product, I think too.
The fixed variable.
Yeah.
So when you're on a variable rate, but your payment doesn't change if the rate goes up or down.
Yeah.
Which I stand beside that.
Yeah, for sure. I think it just brings more education to the market of what could happen, right? You know, you just sign this mortgage thinking, okay, this is my rate. And then you don't really understand what a trigger rate is. Like trigger rate has been the buzzword of the past couple of years now. Like, I felt like when, I first got into the business, you never heard it.
Yeah.
Because rates just kind of,
they
didn't fluctuate like the way they did now.
So I wonder if, let's say Canada was similar to the States, where for the majority of our mortgage products, it was long-term fixed mortgages. Increasing the overnight rate would then only affect small businesses on revolving credit, the service industry, goods and services, HELOCs, all of that. How much would that affect? Because we only talk about the real estate sector, right?
Yeah.
And how people are being smoked on their mortgages. Would it be more effective or less effective? Like the state's doing the 30-year fixed.
I think it would be better. Yeah, I think it would be better. I think it would actually bring clarity to, people who just like don't really understand this stuff as much as they should, right? And it's just like, you just say you're just a casual person and you just like don't, I just want a mortgage, I just want a home for my family, and you sign up and then you're like, oh wow, look at this rate that I got in 2020, and then 5 years goes by and you're like, oh, I didn't even know this could happen. I think it's almost dangerous in a way, but the banks, actually someone comments on our Instagram, like, why do you need to renew a fixed payment or a fixed mortgage? They must've been from the States. And it's, you have to renew a fixed payment. Like, it's almost like, like when you do tell people from the States that, they're like, what?
And when you renew it, they don't pre-approve you. Like if you've changed jobs in that time, unless you've given them a reason to look into you.
Yeah.
If you've just been paying your mortgage, they auto renew you.
Yeah. So the house that you bought, you probably wouldn't even qualify for after, you know what I mean? Like during the depths of the pandemic, if you bought during there.
Yeah. So they auto renew you. So the people that bought in the peaks of COVID on a variable rate, let's say for a year, and we're approaching renewal, even if they wanted to change to a fixed, you could usually lock in with the same bank, but you have to go through a pre-approval if you want to refinance that mortgage with a lower fixed rate offered by different banks. But you likely wouldn't qualify because the value has come down so much and the rates have gone up, or it wouldn't appraise, whatever the case may be. So you can't refinance. You're forced to renew.
Yeah.
No other option.
You
just have to just renew
whatever
that bank is offering you, because you can't go to another bank because they have to pre-approve you, and the value of your house needs to be there.
100%
of your mortgage, right?
I'm seeing a lot. I know people love to hear about it. I'm seeing a lot of like offer nights fail, and people relisting that home at a higher price. And I have been following a few other realtors in like Toronto and Vancouver, and they're saying the same thing. Listings are still low, but this offer night that kind of came back. It was a weird thing that happened earlier this year. That's kind of out the window right now. Like I wouldn't hold an offer date right now unless I listed it really low and it was a different kind of product where I felt like, you could get value of it, but there's always risk with the offer nights, and I just like pricing it right. And so most clients do as well.
2 offer nights this week on my listings.
Update us next week.
Definitely one's going to sell tomorrow. The next one is next week, and we'll see. I'm not too far off what the actual value is. But there's just nothing comparable like it. It's the only 1-bedroom, really nice condo in Toronto. So everything else is 2-bedroom, and the prices, there's so much discrepancy between the comparables that I'm like, okay, I'm going to list here and kind of let the market take it where it should go in this market. And that was my thought process for that one. But I agree with you. It's not every house going in multiples anymore.
No, it's different for sure.
In some markets, yes. Kitchener. Right
Kitchener's still going?
Every single house.
That market's crazy.
It's weird.
Yeah.
It's weird because Kitchener actually fell the most in Canada. Canada-wide, Kitchener saw the biggest decrease in value from the pandemic highs to...
the COVID darling, right?
Yeah.
London and St. Thomas was also up there too.
But now it's going crazy again. So...
yeah. It's still affordable too, to be honest. Like some houses in Kitchener.
Yeah, I just sold a detached house on a really good lot, corner unit with a garage with a walkout basement for $735.
$735, yeah.
Right?
Yeah.
So that.
I mean, obviously we're sitting here being, but like that's just like realtor land, right? Like you put that, you plop that in Burlington, Oakville. It's what?
Exactly. Yeah. Now you're over $1 million.
You need 20% down. That's a whole different ballgame.
It's a whole different.
Yeah. So when we say affordability, obviously we're not naive to the fact that that's still very
it's
expensive.
Still very yes it is. I just mean in relative to driving 45 minutes, you're cutting your price tag in half.
It's a beautiful place too. It's like up and coming. It's there's tech there. There's some great breweries there too. It's like it's a nice little drive. Yeah. You need nightlife, you need stuff to do. I was actually talking to somebody at the gym today too, and we were just talking about someone's situation, and we're just how expensive it is. Like the ultimate hack, to be honest, is to live with somebody. It's the ultimate hack. Like you just think about it in your head, right? Like if you had like even like a friend or something, and like you both share the car, right? You split the car payment, or like
share a car.
Like what I mean is like, you split the rent or something like that. Like living with someone.
Split the groceries.
Split the groceries, split the rent, split the utilities. Because if you're on your own, just think about it, and you want a 1-bedroom, it's going to cost you like a decent 1-bedroom. Like I'm not saying
2-bedroom, split it.
Yeah. Well,
that is a hack.
Yeah. Like $2,500 for a 1-bedroom. And like that's in Toronto too. It's in Oakville too. It's in Burlington. Like it's not cheap. Then you have a car costs you $500 a month.
Yeah.
Like even
at
like
minimum.
At minimum. Yeah. Like even just like an entry level car. Then you have insurance, $200, phone bill, $100. Anyways, you're at $3,500 a month pretty quick.
Yeah.
And then you have to live, you got to eat, you got to go out, you got to have a social life. Yeah. So we were just talking about like, what do you need to make to live in, I guess, the GTA? And it was like $100,000, and you probably wouldn't have much savings.
Jesus.
Yeah.
Or the ultimate hack, and how I started my real estate portfolio is I only was looking at houses that had a basement suite. And even though, and so having a basement suite set up, just in case people don't know this, market rent. So at the time, market rent was $1,800 for a basement apartment of that size. So $1,800 a month times 12, what are you talking, like 24 grand-ish, 22, whatever the case, would be added to your income to be used with your pre-approval. That might boost your purchase price ability up a little bit. But buying, let's say, at $700 versus $600, but having that $1,800 a month income like changes your mortgage payment a ton, because the difference in mortgage payment between 600K purchase and 700K purchase is an 1,800. So you're actually better to spend more, but rent out your basement. So that's what I did. Rented out my basement. At the time, things were a little different, but I lived pretty cheap. And then, then you end up renting the top and continuing. But it is a hack. Living by yourself is
hard, challenging. Yeah. Find love, find a roommate. It makes life cheaper, right?
Find love.
On our last topic here, Korea downgrades home sales forecast as interest rates to stay high well into 2024. So the Canadian Real Estate Association downgraded its resale housing market forecast on Friday in anticipation of interest rates remaining high well into 2024. So despite a continuing upswing in home sales across Canada, month-over-month gains appear to be losing steam as rising interest rates bring uncertainty to the housing market. New listings are starting to catch up with sales, but more would-be buyers are moving to the sidelines as they wait and see what the Bank of Canada will do next. With these market conditions at play, Korea is now projecting 464,239 home sales across the country this year, a 6.8% drop from 2022, and down nearly 30,000 from the sales predicted by the association in its April forecast. So sales in Newfoundland, Nova Scotia, and New Brunswick are expected to fall 15.1%, 14.4%, and 13.9% respectively. Alberta sales will also fall about 13%, with Quebec just behind at 11.4%. Ontario is expected to see sales dip by just under 4%.
And just to clarify, this is number of sales decreasing,
not price.
Prices.
Yeah, it always messes with people.
It's not dipping 15% in price. That's not what we're saying.
No.
The number of sales.
Yeah.
But that blows my mind because we just brought in 1 million people. So bringing in 1 million people and going down 15% in some areas.
Do you think
Ontario's 4? So
Ontario's
here,
so. I know it does kind of skew the data. You just see it right there. But I think the rental market is going to continue to rip. Like, you have people, they just said like on the sidelines. So what does that mean? It's like, well, if they do need a place to live, they're going to go rent. And, renting for people like can be attractive for young people, right? Like I want to live in the city. I don't want to be there forever. I can be liquid. I can move. I can, get a job somewhere else. Like it has that attraction, but also, like you're going to have to start competing for rentals, I think a lot more, but it's a tough.
My Facebook marketplace has like over 100 replies on this one Burlington rental I have. And I was like, oh my gosh.
Yeah.
So
how do you even keep up with that?
I can't. I can't. So I try, but I can't. And it's just wild because actually my listing that I just sold, sadly I had to sell it. Tenants live there. They're being so great. I said, I'm going to help you find something else. The seller can't hold it. Even with your rent, he's negative. He's going to this is not okay.
Yeah.
So they're working with me. Luckily I can find them something the exact same price. We're going to pay for their moving. Because I'm very cognizant of the fact that I'm kind of uprooting the tenants, but I'm going to do my best to make their life easy. But their profile is 4 adults sharing a house. And I'm like, wow, this is a good idea. You guys are all friends. They need a big enough house where they're kind of a little separate, 3 bedrooms upstairs, maybe one in the basement, but multiple floors. You have your space kind of thing. So it's just 4 adults sharing a house and splitting the bills 4 ways. You're going to pay $3,000 for a 4-bedroom house in Hamilton, right? But divided by 4, utilities divided by 4, you're
like $700 each a month.
Yeah.
Well, obviously with more expenses too, but say you come in at $1,000 a month, like that's a lot more affordable than the $2,500 condo downtown.
The only
Toronto,
thing
right?
is that with landlords having their pick, because it's such a competitive rental market, 4 adults that don't have any kind of relation to each other, not in a relationship or not related, you almost think I would think what if one person wants to move, can you guys afford it without them? And there's kind of fights, what?
For sure. Yeah.
Right?
That would be.
I want you to be a solid couple. I ask people when they're a couple, how long have you been together? I don't want a new couple because I'm like, you guys break up, I'm screwed.
Yeah,
right?
True. Yeah. And there's also been profiles too, where it's downtown Toronto, a lot of the time, you do have the roommate where 2 friends go in and 2 girls do way better than 2 guys all the time.
Well, girls
are cleaner.
And to be cleaner.
Not everyone, but
I don't want.
But it is true. Yeah,
get yelled at.
It is true. Yeah, and guys are more inclined to have parties and stuff like that versus girls. But there is there is profiles that landlords do look for. And with rising interest rates, we've said before, it puts pressure on the rental market, which already has a lot of pressure and is already expensive in pretty much every province. So,
and so for the people that are renting that don't know this, if you rent a unit that's built after 2019 or a brand new basement apartment that was built after, like a secondary suite was added to a house after 2019, you are not under rent control.
Yeah.
Keep that in mind. So the people that are living in a house next to you with a basement apartment that was built in 2012 and you're paying $1,800 a month, the landlords can increase the rent by the guidelines, 2.5% or something like that.
Yeah.
If this basement apartment is new, a new dwelling, and you rent it today for $2,000, next year the landlord's mortgage goes to doubles, whatever, or won't double, but I mean goes up. They can say, hey, you owe $3,000 now, and
or get out.
Yeah. So keep that in mind after 2019,
especially with the condos. Yeah, like new condos that you go into. Like, it's true. You go into a new condo and you're like, oh, it's all brand new. I love it, but yeah, you're not subject to rent control, so they can jack the rent to whatever the market rent is. I think it's November of 2018, and this is in Ontario. Okay, so this is in Ontario.
November of 2018.
Yeah, this is in Ontario too. Just to preface, I don't know about other.
I don't know about other provinces either.
I'm not sure, but just to keep that in mind if you are rental shopping, like, hey, just know this could go up quicker than the guidelines. So
yeah, they could literally put it to whatever they want.
I think it has to be market value.
Market value, Yeah, they can't charge you $10,000 if market value is 4. It has to be market value, but they don't need to go up at that steady increase. So I saw people building these basement apartments are only looking for newer ones because the landlords don't want to be controlled. They want to be able to afford their mortgage with their rentals and not have to be in a position where they're negative.
Right.
I actually haven't raised my rents on my tenants in 2 years.
They're good tenants. Don't do it.
They're good tenants. Yeah. They're good tenants, and I'm negative now on one of the houses, and thankfully I'm positive on another one. It balances all out, and I'm okay. But I didn't raise it because I value the fact that they're taking care of my house rather than making it $200 more a month and having to find other tenants. I'm like, you guys are worth that to me.
For sure.
And I know that they respect me for not even raising it based on the guidelines. It's like, win-win. You take care of my house, I'll take care of you.
Yeah, works.
And be a good landlord.
Everyone's happy.
Yeah.
Anyway, that's all I had to say. You have anything else?
That's all for me.
That's all. All right, cool. Well, thanks so much for watching, guys. If you're on YouTube, please like and subscribe to the channel. We're trying to grow it as much as we can, as well as Spotify and Apple Music. Please leave us a review. We're also on Instagram and TikTok if you guys want some short form stuff. And we were on a podcast last week too, so hopefully we'll share that with you guys as well as our first kind of getting interviewed podcast. So it'll be fun.
We had a little banter.
We did have some banter.
We got into a fight.
Yeah, we got into a semi-fight. I don't think we're ever going to get invited back on that podcast. No, I'm just kidding. All right, thanks again, guys. Take care. See you next week.
See you.